Welcome to the session on investment decisions with under risk and uncertainty. Now, we have seen how this capital investment decision or the capex in general, how to invest in a project which gives us a good rate of return. So, we have done the cash flow calculations, we have done the various techniques that we use on these cash flow estimates, so that the company in the long run stands to gain out of this investment. Now today we'll talk about till now we have been talking about the cash flows which were known to us with certainty. Now today we'll talk about scenarios when the cash flows or the projects that we're investing, they are under the risky category, or we are not able to predict the cash outflow, the cash inflow from the projects. So how to deal with these kind of investment projects is what is the discussion for the topic today. And you see, the for the calculation of cost of, when we talk about the project, with the techniques that we have been using till now is the NPV, the net present value, or the internal rate of return, which is the IRR. Now, in either of these cases, we are dependent on something called a cost of capital to discount the cash flows, and in case of NPV, we use the cost of capital, or K, to discount the cash flows. And in case of IRR, we used to compute the rate of return and then compare it with the cost of capital to be able to take a decision of whether to invest in this particular project or not. Now, this cost of capital K is calculated through a model which is called the capital asset pricing model. Now, this capital asset pricing model is a recent development, maybe 25-30 years back, but long before the CAPM became popular. The CAPM says that the risk of a company is linked to the market. We'll just see a brief discussion on the CAPM very shortly. But the CAPM, which says that the risk of the company is linked to the market portfolio. Now, long before this CAPM came into picture, the capital investment decisions were still going on, and the managers who were in charge of this capital asset, this capex, the capital investment decisions, they had the intuition and the smartness to know what to do in case of projects which are not very risky. Now, if I'm talking about a project which is about the current business expansion of a particular company, then the company is already established in the business and you are expanding your current capacity. So that will be a lesser risk project. Whereas if you are venturing into new product, for example, diversification and such kind of activities, then the company doesn't have experience or exposure in that particular area. So it's unknown territory. So the risk of that kind of a project is very high. Now, the managers, they intuitively know what to do in case of an expansion kind of a project and what to do in case of a diversification kind of a project. Now, you see, and they knew that when we're talking about two projects, one is a risky one, that is a diversification one, and the other one is less risky, that is the expansion one. So it is always desirable to stick to the less risky project as compared to the risky one. Now, intuitively, what they used to do is they stick to either of the two things. That is, for risky project, you can demand a higher rate of return. So your cost of capital of a risky project will be higher. Or what you do is, when you are estimating the cash flows from a risky project, you go for a very conservative estimate of the cash flows. See, it is the cash flows which are risky of this particular project. So either you do one thing, downplay the expected cash flow and become very conservative while estimating the cash flow. That is one aspect. The other aspect is that you they adjust the rate of return to reflect the risk. So you generally opt for a higher cost of capital. Now, the companies, they estimate the rate of return. When we're talking about this cost of capital, now these companies, that they estimate the rate of return that the investors, the company's investors, as they require based on its securities. Basically, let us say when we're talking about debt, we're talking about the cost of debt and debenture, and when we're talking about equity, we are talking about the cost of equity shares. Now, and when we are using this cost of capital to discount the cash flows of all the new projects. But since investors require a higher rate of return from a very risky company, this kind of a firm will have a very high company cost of capital, and hence the discount rate is going to be very high for the new projects that the company takes up, that is the capex. Now, this is what the scenario was prior to the CAPM. Now, of course, we have now techniques available to deal with this kind of risk. We'll go to that, how this risk and uncertainty is dealt with. Before that, let us just have a brief recap about the CAPM, or that is the capital asset pricing model. Now you see, in capital asset pricing model, this is the go-to technique to estimate the cost of equity. Now, using CAPM approach, we estimate the risk-adjusted discount rate for making the investment decisions. Now, this theory talks about how the prices of the equity shares, they're fixed in the they're determined in the capital market. Now, from that, we derive the rate of return expected on an equity. So, the rate of return expected on equity is nothing but the cost of required rate of return of investors, or for the company, it is the cost of capital. Now, without going into detailed nuances of the capital asset pricing model, we'll just look at the graph that represents the capital asset pricing model. Now, see, here you can see the CAPM is basically represented through the security market line. The security market line is a line which shows the equilibrium position of all sorts of assets in the investing universe. Now, the portfolios will find a place on SML, the individual equity shares will find a place on SML. So, the SML can show the equilibrium position for all the assets available in the investment horizon. Now, here in this graph, we see that on the y-axis, I am depicting the expected return, and on the x-axis, we are depicting the systematic risk of the company, which is CAPM talks about a company, not about a project. We will try and see how the CAPM can be used for a project also. For now, on the x-axis, I am plotting the beta of a company, and the line depicting SML shows the various kinds of equilibrium position of expected return at different levels of beta. Now, there is a dashed line here on this, which is showing the beta is 1, that is the position of the market portfolio. Okay, now we'll see how do we derive these equity returns from this. Now, the equation of SML is RI is equal to, RI is the return on the I number of security, is equal to RF, where RF is my risk-free rate of return, plus beta into the there is a bracketed term which is the expected market return minus the risk-free rate of return. In fact, the term which appears in the square bracket, that is the market return minus the risk-free rate of return, that is called as the market risk premium. Okay, now you see in this equation, the RF, that is a risk-free rate of return, that is constant and is common to all companies. Similarly, the market return minus the risk-free rate of return, that is the RM minus RF, that is the market risk premium, is also constant and common to all companies. Now, RF is common to all companies, the RM minus RF is common to all companies. So, why then the companies have different cost of capital? They have different cost of capital because each company has a different beta. So, if a company has higher beta, of course, it will have at the same RF and market risk premium, RM minus RF, a company having higher beta will have higher cost of capital as compared to a company which is having a lower beta. Now, that is the significance of the beta. Beta measures basically the systematic risk of each company. Now we can also compute beta by doing this calculation, that is the covariance divided by variance. Covariance as in the covariance of the individual stocks return for whose beta we are interested in, the covariance of that particular stock's return with the market return divided by the variance of the market. So if we do that, then we can easily compute the beta of a company. We can use Excel sheets and we can plot these RI and RM on these Excel sheets, and we can also compute the beta from that. Now, the capital asset pricing model, the theory tells us to invest in a project which offers a return that is more than compensates for the project's beta. Now, to work with beta, how will it look like? Let us have a look. Now, see, if you're talking about a hypothetical company which is called the ABC Limited, which has a beta of 1.38, let us assume, the risk rate of return is taken to be 7.8%, and the expected market risk premium, here I am talking about RM minus RF. That means RM minus the 7.8%, that works out to 9.1%. So the market risk premium is 9.1%. Now, if a company has a beta of 1.38, what will be the expected return on its equity? The expected return, if we plug in these values of RM and RM minus RF and the beta of 1.38, we get the expected return to be 20.3%. Meaning the expected rate of return on this particular company's stock is 20.3%. In essence, a company, this particular company will have a cost of equity equivalent to 20.3%. The company cost of capital, ABC should have been using a 20% discount rate of 20.3. So I'm telling about a round figure, that it should be using a cost of capital K of 20% to evaluate its various projects, to find out the net present value using the NPV, or to compare the IRR with this 20% and then take a decision regarding the suitability of a project. That is how we employ CAPM in computation of cost of capital, and then in essence use that as a technique for project appraisal. Now the point is, now see, even the betas are not directly measurable, they are not directly observable, and it is also not very easy to measure the betas, because see, the market risk premium cannot be known with certainty. Okay, so the RI is fluctuating and the RM is also fluctuating. So we can do a regression analysis of these two and we can reach a consensus beta. So however, even if they are fluctuating and not very directly measurable, it is still quite reasonable to assert that the ABC is facing more risk than the common firms, because now you see ABC has a beta of 1.38, which is more than 1. The market beta is by definition 1. Now, which means the company has more risk as compared to the market portfolio. So it is a quite a risky company. So the cost of equity is adjusted to 20.3%. Okay. Now the point is, however, if we only are dependent on CAPM for evaluation of a project, we can obviously run into several problems. We will just see what kind of problems can be encountered if we talk about the CAPM only. Now you see on the right hand side, I'm still showing you the, this particular company's case, which is where the risk-free rate of return was 7.8% and the market risk premium was 9.1%, and this 20.3% straight line, there's a parallel line to x-axis, that is I'm showing as a company cost of capital. Now, what could be the problems if you are only dependent on the CAPM for the project evaluation? Now, the company cost of capital rule can also get the firm into trouble if new projects are more or less risky than the existing business. Now, just in the beginning, I was telling that if you're talking about an expansion project, like your company is in the business of steel manufacturing, you already have experience in steel manufacturing and you have been operating with a capacity of 10 metric tons a year. Now you want to expand that to 30 metric tons a year. Now you are already in the business, established in the business, you have a know-how, you know what to do to reach 30 metric ton. So that kind of a project is called as a expansion project. And for this kind of a project, if you are using this parallel line, that is the 20.3% of cost of capital, that's fine. There is no issue with that. But if you're talking about a business which is in the diversification, suppose now from steel manufacturing, you are moving into, let us say, refinery business. Now refinery, you have no exposure, no, you have no experience to the refinery business. Now if your company decides to use refinery, is going to be risky for you because you have absolutely no track record dealing with it. So that is going to be a very risky project for you. Now for that project also, if you are using a cost of capital which is 20.3%, that obviously will lead into problems. Now because see, that is a diversification project which is a very risky one. You cannot have one cost of capital for less risk, the low risk project and a high risk project. Now so every project has to be evaluated by its own opportunity cost of capital, which is commensurate with the risk that the project is encountering. Now, for example, let us say we are using this very famous principle of this NPV, that is a value additivity principle. Now, according to the value additivity principle, a farm's value, basically, suppose a farm has only two projects, A and B. So, the farm's value is nothing but the present value of the project A and the present value of the project B. Now, if I am using the same cost of capital to evaluate A as well as B, then there is a problem, because you see, present value of A and present value of B are valued just as if they were two mini farms. A is a different farm and B is a different farm. So I suppose, hypothetically speaking, if I can invest in a farm A, which is dealing with the expansion project, and I can also invest in a farm which is farm B, which is dealing with the expansion project. You think of yourself, will you be able to do justice, or will you be happy if you are investing in A, which is a steel business, which is a company which is in the steel business for last 20 years and now trying to expand? You will be happy with 20%. Now the steel company now trying to venture into refinery business, they are offering you 20%. Do you think you will be happy in either case? You most definitely, you would drop B and you will move to A. Now the whole issue is, investors would value A by discounting its cash flow at 20.3%, but they will not do so for the project B at 20.3%. So they will do some kind of adjustment, whether it is the adjustment with the B's cash flow or whether it is the adjustment with the B's cost of capital. That can be discussed, but they will not use the same cash flow or the same rate of return to discount B. Now, so obviously for A, I'm going to use a different cost of capital. For B, I'm going to use a different. The common sense is that even if both these projects are taken up by the same farm, so the CAPM, see, if you are dependent on the CAPM, now you see the cost of capital of the company is this crossover point, that is a 20.3%. So for project A also you are going to use 20.3%, project B also you are going to use 20.3%. Now assuming that both the projects are of two different farms, mini companies, A might have a beta of 1.38, so okay, 20.3 is fine, but B might have a beta of 1.5. Now, if a company has a beta of 1.38 vis-a-vis 1.5, so 1.5 beta will be on the slanting line on the SML, and you have to, this is the point, this point is for the 1.38. You have to move up here. Let us say 1.5 beta. If I can draw it here, it will be 1.5. Now, the point is, if you are going to stick to the the horizontal line to assess the cost of capital, you will definitely run into problems. So you are likely to use, you are supposed to use the SML and the beta of the project to evaluate what is the cost of capital of the particular farm. Now that brings us a new set of problem, that how to compute the project beta, because we have known how to compute the market, the company's beta, but project beta is a different ball game altogether. Okay. Now, the CFM again tells us to invest in any project which offers a return that is more than compensates for the project's beta. ABC should have accepted any project above the upward sloping market line. If the project had a high beta, ABC needed a higher prospective return than if the project had a low beta. So obviously A and B will fall at different points on this landing line. Hence A will have a different cost of capital, B will have a different cost of capital. However, if we go by the cost of capital rule, we are going to use the horizontal line, that is the 20.3% for all the projects, which is, I mean, now with this intuition, we can imagine that this is not the right approach. Now, it is really foolish to suggest that ABC should demand the same rate of return from a very safe investment as well as from a risky one. Now, you cannot simply, so that all I'm trying to tell you is that if you use the company cost of capital rule, you might end up rejecting good projects and you might end up accepting bad ones. That is a dangerous scenario for a company to be in. Now, how do we measure the betas and what about the project betas? Now you see the beta is very difficult to measure and accurately for any individual firms, because the firm's borrowing policy also affects its stocks beta. Now the borrowing policy, as in the talk about the financial leverage, it is very incorrect to average the beta of a company which has borrowed heavily and compare it with a company which has no borrowing at all, because a company which has borrowed heavily has exposed itself to huge amount of financial risk as compared to a company which has not borrowed. So you simply cannot average or compare with similar kind of companies in the industry. Now the company's cost of capital is the correct discount rate for a project that have the same risk as the company's existing business. Okay. Suppose we're talking about a project whose beta is 1.38, then you can use the company's cost of capital. But for projects whose beta is other than 1.38, it is not good to use the company's cost of capital of 20.3%. Now, having talked about betas, even if we are able to correctly estimate the beta as of now, the betas of projects keep on shifting. Now, a project might be less risky in the beginning, it might become riskier in the towards the later part of life. The vice versa can also happen. A project might be more risky in the beginning and can become less risky over a period of time. So these accordingly betas of companies the projects, they also shift over time. Now the estimates of betas are only imperfect guides to the future, is that the stock may genuinely change their market risk. Now, the betas in any one period is just the estimate based on the limited number of observations. So, when I am calculating beta as of today, I am basing my observation on today's market return and today's stock return. Now, the what happens is many times a good news about a company coincides with a high market return. Now, so for example, the market has made a huge jump due to some reasons, and on the same day, a company also ABC company, suppose, has a good news. So at that point of time, it will appear, if you are computing the beta, then it will appear that the company has a very high beta, because the market has jumped, the company's returns are also jumped because of the good news. The stock beta will, if you calculate at that point of time, it will be higher. It can also be twisted the other way around. Now, suppose the bad news about a company coincides with the market fall, then you might assume that the beta is low if you compute at that point of time. So, a company whose beta appears to be very high, it may be because it really has a high beta, or we can also be manipulated into thinking that the beta is really high. You might have overestimated it. Now, this kind of thing happens. Good news coincides with market jump, then beta, though it is not high, will estimate it as high because of the inherent calculation process of the beta. Vice versa. So the beta that we're observing right now, that also is under question, because whether it is the true beta or it is the overestimated or underestimated beta, it is very difficult to assume. With experience and with frequent dealings with beta, probably you can develop insight into finding out what could be the true beta of a company. Now, when we talk about these project betas, we have to talk about something called the asset beta. Now, you see, a company, suppose I'm talking about a company whose total, funding is debt and the equity. There are no other funding source available, only the debt and the equity. Now, if I am the whole owner of this particular company, I own 100% of the company, then obviously my company's value is nothing but the debt value plus the equity value. Now, so the asset value of my company, so this is my source of funding, right hand side is my source of funding, and the left hand side is my use of that particular fund. So the farm value is nothing but the total asset value, that is the value of the debt D plus the value of equity E. So the V farm value is nothing but D plus E, which is V. Now, accordingly, the beta of asset is the proportionate beta of the debt and the proportionate beta of the equity. Now, suppose we talk about I'm the whole owner of a company, so my portfolio now has some amount of debt and some amount of equity. So what is the total beta of my company? So that will be the proportionate beta of the debt and the proportionate beta of the equity. Now, what do I mean by proportionate debt? Proportionate debt is, suppose my company's funding is total 100 rupee. Out of that, if 40 rupees invested in debt, then the beta of the debt into 40% plus the remaining 60% is in equity. So beta of equity into 60%. So that is the proportionate beta. The aggregate figure will, the weighted average will give me the beta of the asset or the farm. Now, we'll see how this is done in practice. See, if you are talking about a company, suppose this particular company has a stock beta which is 0.36, and the equity stock accounts for, let us say, 35% of its market value. So the E part is 35% and the remaining is 65%, that is the debt part. And by definition, now by definition, this by definition, the beta, the asset beta, the beta of the debt is 0, because we are most of the time the debt is considered to be risk free. Suppose we are assuming that the beta, the debt is risk free, and here your risk is 7.8% and the expected market risk premium is 8.3%. So in that case, how do I assume? We first talk about the the asset beta. So what is the asset beta? The debt beta of debt is 0 into the proportion of debt, that is now D is 65% divided by 65% plus 35%, that is 100%. So into 65.65 plus the equity beta, that is 0.36 into 0.35. So that gives me the asset beta or the farm's beta to be 0.13, which is very low. So where this turns out very low because we have assumed that the debt is risk free. Now, the cost of capital of this particular farm, how can it be computed? We can plug in the values into the CAPM equation. That is again the risk-free rate of return 7.8% plus the asset beta, which is the beta of the farm, which is we just calculated as 0.13 into this 8.3%, which works out to 8.9%. I guess this calculation is correct. So this works out to 8.9%. Now the point is, so 8.9% is a very low rate of return on the equity for this particular farm. Now, if let us say assume that the debt is not risk free, so then we will have a different beta value. Suppose we have assumed that the beta value of debt is 0.15. Now, what is the asset beta? Here in this case, my asset beta is 0.22. Now, plugging these values into the CAPM of 0.22, so that gives you the company's rate of return to be 9.7%. So that is how we talk about the various debt betas, equity betas, and the various asset betas. Now, we come to something called a business risk and financial risk. So I'm sorry, this the and is missing here. The business risk and the financial risk. Now, there is a term called leverage. When we talk about the leverage, we talk about the both kinds of leverage, the operating leverage as well as the financial leverage. When we're talking about operating leverage, basically that deals with the business risk, and when we talk about the financial leverage, that talks about the financial risk. Now we'll try to build in this business and financial risk into the capex context. Now the firm's beta, asset beta, reflects it's the business risk. That means a particular company's total beta, which is nothing but the beta of the weighted average beta of the debt and the weighted average beta of the equity. The total beta of a company is known as the business risk. Okay, that is and the difference between its equity and asset beta, that is the beta of equity minus the beta of the asset, that talks about the financial risk. Now the when we're talking about the more debt means more financial risk. Okay, so because what we are doing with debt is the concept of financial risk is having fixed financial charges in the to pay for the company in the income statement. If you have fixed financial charges, then it is said that the company has a financial risk. Now what do we mean by the fixed financial charges? Now fixed financial charges are the charges which are called the fixed cost, fixed financial cost. That means irrespective of the level of operation and irrespective of the profit margin, profit figure that you're having, this is something that you have to pay. And what is that fixed charge? It usually arises in the form of interest, a form of interest on the term loan or on the debenture. So if you have more and more debt capital, suppose you have 5 lakh debt capital at 10% interest, so then your financial charge is 50,000. Now you increase your debenture to, let us say, 20 lakh. So now you will have 20 lakh on that 10% interest charge. So you will have a 2 lakh interest, to compare to the previous case where interest was 50,000. Now your interest is 2 lakh. Now the 2 lakh is a mandatory payment. It doesn't matter. Now say where from we deduct this 2 lakh, we deduct it from the EBIT, that is the earnings before interest and taxes. Now the issue is, if my EBIT is less than 2 lakh, then what do I do? Then also you make the payment of interest, that is a 2 lakh. You might have to borrow another, go for another loan, borrow another amount, and then pay interest on that, interest from that. Now the issue is, so the more amount of debt capital that you are employing in your firm, the more is the fixed interest payment that you are incurring, and that fixed interest payment is known as the financial charge, and that amounts to the financial risk. So it is said that the more and more debt you have, the more and more is the financial risk of your company. And with how do we talk about this financial risk in terms of beta? Now you see, we'll try to alter this particular equation that we have just dealt with. The beta of the asset is equal to the beta of the debt into d by d plus e plus beta of equity into d by d plus e. Now the point is, I change the sides of the equation. I change the equity to the left hand side, and asset I bring it to the right hand side, and do some modifications to the equation, and then I ultimately reach at this particular new equation, that is the beta of equity is equal to the beta of asset plus the spread between the beta of asset and the beta of debt, multiplied by something called d by e, which is also technically known as the leverage. Now see, if a firm has no debt, okay, so if a firm has no debt, so this d by e becomes 0, because d's value is 0. So the total d by e, the debt by equity, which is called the leverage ratio also, so the d by e becomes 0. Because the d by e is 0, now the entire this part of the equation is becoming 0. Now, so your beta of equity is nothing but the beta of asset. Obviously, because We have just seen that the beta of the asset is the weighted average beta of the equity and the debt. If you have no debt, then the beta of the asset is equivalent to the beta of the equity. Now, see, when we're talking about observed equity beta, from this equation, it is not difficult to estimate that the beta of equity is dependent on the spread between the asset and debt beta, and also dependent on something called a leverage. So, because beta of the asset remaining constant, now the spread, higher the debt, higher is your risk, and higher is your leverage. So D by E value is the spread and the leverage. It is that which will decide what will be the beta of the equity. Now you see everything is remaining constant, only leverage is increasing, D by E is increasing. So with leverage, increased leverage, you will have increased beta of equity. Okay, that is what I was trying to tell you when I told you that more debt means more financial risk and in effect more beta of equity. Now, if you plot this, this equation on this graph paper, now you see on the y-axis, I'm showing you the values of beta. On the x-axis, I'm showing you the values of the leverage ratio, that is the debt equity ratio. Now we start with no debt here. The point of origin is the point of no debt. So d by e is 0 at that point of time. Now if the d by e is 0, the value of the equity beta is the beta of the asset. That is what we saw in the previous equation. Now as you go on adding debt to your company along this particular axis, as you go on adding more debt to your company, the beta of your equity keeps on increasing along this this slanting line. Okay, so the beta of the equity is not only dependent on the spread between this, but also dependent on the level of D by E. So higher the debt equity ratio, the higher the beta of equity. Okay, so the beta of asset measures the, now we started with the concept of the business risk and the financial risk. So the beta of the asset, the total asset, on this thing, that measures the weighted average beta of the equity and the debenture, that measures the business risk of the firm, whereas the spread measures the spread between this asset and this debt, that measures the financial risk of the company. So a company could have both together, business risk as well as financial risk. It can have only one of the risk there present. Okay, so when we talk about the asset betas, now which are the dominating factors that affect the asset betas? When we talk about these dominant factors, the one factor that is present is called the cyclicality. Now, what is the meaning of cyclicality? The cyclicality is how the business cycles they fluctuate, and as per the business cycle, how your company's beta, your company's revenue, your company's these things, how they are changing, that is called as the cyclicality. Now you see the many people they associate this risk with the variability of the book or the accounting earnings. Now how your accounting earnings or how your profits they are changing as per the changes in the business cycle is what the cyclicality means. Now the business cycle goes through a cycle of, let us say, expansion, then reaches peak, then the recession, then reaches the trough, the bottom point. So you can have a wave kind of a this thing business cycle. Now basically when a business cycle means the phase of the economy. Now if your profits or the earning figures keep on changing with the business cycle, then your company is said to be highly cyclical. So examples of cyclical companies could be, let us say, like automobiles. Okay, automobile stocks, automobile companies are highly cyclical. So in a case of economic upswing, the automobile sale will be very high. In case of economic recession, it is the automobile sales which will take a biggest hit. We saw, in fact, this kind of a scenario during the corona, where the sale of the automobile sector, it dropped around 90% drop was there in during the peak corona period. The new automobiles took a hit. The orders on the new automobiles that took a big hit. Now, these kind of companies are called as the cyclical. Now, there could be companies whose, earnings and the profit figure, they're not that much affected by the business upswings and downswings. You could talk about companies like, uh, I mean, yes, pharmaceutical companies like food processing units. So they are impervious to the business upswings and downswings. Even there could be companies which could be counter cyclical. Counter cyclical, as in the companies whose earnings and profits will be higher in economic recession, and so to say, and not so high in case of economic upswings. We could also have companies which are called counter cyclical. Now, the firm whose revenues and earnings are very strongly dependent on the business cycle, they tend to have very high beta, because these companies will be taken for a ride along with the economy, so they will have very high beta. So if you are dealing with a company that is cyclical in nature, you should always demand high rate of return, and these kind of companies will have high cost of capital, and when they invest in particular projects, they will tend to employ higher cost of capital to estimate those kind of projects. Okay, it might not be the case in case of the defensive kind of stocks, who are not very cyclical. They're called as defensive. Now, one of the aspect is the asset beta is determined by the cyclicality. If you're too cyclical by nature, you will have a high beta, high asset beta. If you're a defensive firm, your asset beta tends to be low. Then we talk about something called the operating leverage. We just discussed, like financial leverage talks about the employment of the fixed financial charges. The operating leverage talks about the employment of fixed charges in the manufacturing setup. That is, you will have fixed cost. Now, when we're talking about fixed production charges, now when we're talking about fixed production charges, what is the example of fixed production charge? Maybe the rent, the electricity. This could be the example of fixed charges. Now, when we're talking about fixed financial charges, this adds to the beta of a capital project. We'll see just shortly. We'll see how that is happening. Now, you see, when we're talking about the company having operating leverage, the cash flows generated by any productive asset, it can be broken down into revenue, fixed cost, and variable cost. So, what is this? Basically, profit, not cash flow. We should not say cash flow. We should be saying, let us say, profit. Now, the profit is equal to or cash inflow. Profit and cash inflow, that's two different things, because profit may not always translate into cash. But anyways, for the sake of understanding only, we're talking about cash inflow is equal to the revenue minus the fixed cost minus the variable cost. Now, the cost which are dependent on the rate of output. For example, raw material. You are producing 100 units, you are using 100 units of finished good, you are using 100 units of raw material. If you are producing 500 units of finished good, you are going to use 500 units of raw material. So, these kind of things are called variable cost. So, the raw material, the sales commission, the some amount of labor and maintenance cost, these are all variable by nature. So, when we're talking about fixed cost, the cost which are even if you are producing at a high rate or you are idle, this kind of cost will remain more or less constant. For example, you have property taxes, you have wage of workers who are under contract. Okay, they are under contract for 1 year. Whether you make them work for 8 hours a day or you don't give them some job on a particular day, you are going to pay them. So, these kind of things are called the fixed cost. Okay. Now, if we can break down the assets present value in the same way, now that is the present value for assets is equal to the present value of your revenues minus the present value of the fixed cost minus the present value of the variable cost. Obviously, because you see your revenue minus fixed cost minus variable cost gives you the cash flow. Now, so the when we talk in terms of present value, the present value of revenue minus the present value of cost minus the present value of the fixed cost and the variable cost will give me the present value of the cash flow, which is nothing but the present value of my farm or present value of my asset. Or what I can write is, I just change the side of revenue to the left hand side and bring the asset to this side. So what I have present value of revenue, which is equal to the present value of the fixed cost plus the present value of the variable cost plus the present value of the asset. Okay, so because I just changed the sides of the equation, so I have now the present value of my revenue is nothing but the present value of the cost I'm incurring, the present value of the variable cost I'm incurring, and that is the present value of the plus the present value of the asset. Now here what we see that those who receive the fixed cost, my company is spending certain amount as fixed cost. Now the one who's receiving that particular fixed cost, they are like the debt holders in a company. Now you see, if I am buying the venture in a company, I'm entitled to get fixed amount of interest every year. Similarly, somebody who is receiving a fixed cost from me, nothing less than a debt holder, because I am giving him some amount of cash every year, maybe on a different heading, but the cash out nature of the cash outflow for debt holder and for the fixed cost, the party who is receiving the fixed cost, they are the same. So the ones who receive fixed cost are like debt holders, and the ones who receive the net cash flow from the asset are like holders of levered equity. Levered equity as a company which has debt and the equity shareholders of that particular company. Now, when we talk about in terms of beta, when we talk about this operating leverage, so I can put this beta values here. So in this equation, I'm just putting the beta values here. Now, the beta of revenue is equal to the beta of fixed cost into the present value of fixed cost by present value of the revenue. I'm talking about the weighted average beta now. The is equal to plus the beta of the variable cost into again the variable cost by revenue plus beta of the asset into the present value of asset by present value of revenue. Now the point is, all I'm trying to do is trying to show you the impact of operating leverage on the beta value. Now the beta of the value of the value of the revenue is simply weighted average of the beta of its components part. Now, what are the component parts of the revenue? The component parts are fixed cost, the variable cost, and the asset. Now, the beta of that particular revenue is dependent on the beta of the fixed cost, beta of the variable cost, and beta of the asset. And what kind of beta? I'm not just adding up the betas of fixed cost, variable cost, and asset. I'm going for weighted average. Weighing the fixed cost with its specific weightage, variable cost with its specific weightage, and the asset with the specific asset. So now the point is, the fixed cost beta is zero by definition. When we talk about this fixed cost is fixed by nature, so there is no fluctuation. So like we said that the holder of the receiver of the fixed cost behaves just that like of a debt. So we may by definition make it zero. So the betas of the revenue and the variable cost should be approximately the same, because they respond to the same underlying variable rate of output. Now you see what remains is the beta of the variable cost and beta of the asset. Now I'm trying to tell you is the beta of the variable cost and the beta of the revenue, both are fluctuating in nature, and both of them, they respond to the similar kind of business scenarios. So because of that, it is said that this beta of asset is dependent on this beta of the revenue and beta of variable cost, and both of them fluctuate to the similar kind of market scenarios. So if the higher amount of operating leverage that you have, the higher will be the asset beta. Okay, so if we substitute the beta of revenue for beta of variable cost, now you see this is what I am substituting here. Here I am substituting and solve for the asset beta with beta of fixed cost as 0. Now this is what it will look like: beta of asset, and then rearrange the equation. So the beta of asset is equal to the beta of the revenue into present value of revenue minus present value of variable cost by present value of asset. So it is nothing but the beta of my revenue into 1 plus the present value of fixed cost by present value of asset. So what happens is, if your company is cyclical by nature, the revenue is cyclical by nature, which is reflected in the beta of the revenue, the asset beta is proportional to the ratio of the present value of fixed cost to the present value of the project. Now, the present value of the fixed cost to the present value of the project, it is this now asset beta is proportional. Now you see the here you have asset beta, here you have revenue beta. Now revenue beta and asset beta fluctuate are respond to the same kind of cyclical business scenarios. Now it is more dependent than on this particular ratio of the fixed cost to the asset. Okay, and now having discussed about this operating leverage and the impact of this operating leverage, now we talk about something called, we have discussed too much about how you estimate the risk and the required return of a project, for a project. Because we had the necessary techniques to determine the cost of capital of a particular company, but we just saw what kind of techniques, what kind of iterations have to be done to deal with the risk of a project or beta of a project. Now we'll shift our attention a little bit to something called the risk adjusted discount rate. Okay. And we'll try to do it for the how that changes over a period of time, and we'll deal with something that is a long life of a project. Now, you see, when we talk about the discounted cash flow approach, we will now deal with the changing profile of risk over the life. Now, we have earlier implied that the expected return that is calculated from the capital asset pricing model through this equation, that deals with the fixed kind of, now once we calculate the RI or the K or the cost of equity KE, now and then using that particular KE we calculate the WACC, that is a weighted average cost of capital. So basically we're assuming that the cost of equity remains constant over the life of the company or over the life of the project. Now, so basically what we can do is, if we talk about a discounted cash flow approach, suppose you have 1 year cash flow. Suppose next year you are going to receive only one cash flow, that is C1. Okay. So what is the present value of your C1? The present value of your C1 is C1 divided by 1 plus R to the power T. Okay. And if you have a multiple period, then it is sum of those present values. Okay. So here I am showing you the present value, which is you have multiple cash flows like C1, C2, C3. So I've done it, put a this thing summation sign here, and put the values of CT, and then 1 plus R to the power T. Now, instead of this R, what I'm doing is assuming that the company is all equity, there is no debt. So I'm plugging the value of R here, that is 1 plus this CAPM equations value. I'm plugging it in here, that is 1 plus RF plus beta into RM minus RF to the power T. Now here the inherent, if you think that then my problem is solved, I have incorporated the CAPM into the calculation of the project beta, then we are committing some kind of error, because here the inherent assumption that I have made is that the beta of the company is not changing over a period of time. Okay, the beta is stable over a period of time, and the risk profile of a company is not changing over a period of time. Now, but we know that that is not the case, because over passage of time, the risk, of a project keeps on changing. Now, so how we deal with that kind of a changing risky scenario? Suppose the risk of the project changes throughout the time, then what can I do? Either I adjust the cash flow, or I adjust the bottom, that is the risk free, the rate of return at which I'm discounting. Now you see, if we talk about a single cash flow, that is a C1, and assume that cash flow to be certain by nature, what I can do is I discount the C1 once by using the RF, that is C1 by 1 plus RF. So F will be subscript here. Anyways, now the cash flow, suppose this is the case when the cash flow is risk free. But if your cash flow is risky by nature, then this procedure may not be sufficient to deal with your present value. Now, in that case, I have to replace this RF with a appropriate rate of return. And how do I do that? I can do that. Now, see, it's a pertinent question I'm asking here is that, now if the cash flow is risky, the can I do the normal procedure? No, I cannot do, because RF cannot be used, because RF is the risk-free rate of return. Then what is that rate of return which I can use? Now, before I try to attempt to answer that question, I would like to answer this particular thing, that what is the, now for example, if I give you a scenario where, will you accept, suppose I toss a coin, okay, and there is a head come, the chances of head coming up is 50% and the chances of tail coming up is 50%. Now I give you a game that whether you will accept 500 rupees without any tossing game, or will you accept 800 rupees if I toss the coin and the coin comes out head, and if I the coin comes out in tail, then I'll not give you anything. So which one will you choose? Will you choose a certain outcome of 500, or 800 with heads and nil with tail? This is that's kind of a scenario. Now the point is, what is the smallest certain rate of return which I would exchange the for a risky cash flow? Now with some kind of risk, what is the cash flow? Let us say 1000 rupee with risk, or 800 rupee without risk. So what is that cash flow? That cash flow is known as the certainty equivalent of C1. Now when we're talking about the certainty equivalent of C1, what I can do is I can put this now C1 is my risky cash flow. So the C1 I'm discounting by a different rate of return, that is the R, commensurate with the risk of C1, is equal to certainty equivalent, which is the risk free, that has to be, that is discounted with RF, that is the risk free rate of return. So here you see different R and different RF. Now if I want to know the relationship of the certainty equivalent and the risk adjusted discount rate formula for asset for a project which is long lived, I can plug change those things into this to compute the NPV of a project. Now the project, this is a present value, I can deduct the initial investment to get the net present value. So how do I compute the present value? If we are talking about certainty equivalents, I discount them by RF, 1 plus RF. If I'm talking about the risky cash flows, I discount them using 1 plus R plus something called A to the power T. AT. Now, what is this AT? It is the ratio of the certainty equivalent of a cash flow to its expected value, which is the certainty equivalent divided by the CT. Usually, it is positive but less than 1. Okay, so if I can do this kind of changes to this equation, I can deal with the different kinds of discount rate for different cash flows, which are risky and which are not risky. So we come to the end of today's session. Thank you.